Right. So, warm welcome to everybody again, and I want to introduce you to Aidan, who is the Director for Accounting for Creators, and we're going to talk a little bit about, your entity, the tax liabilities that you should be aware of, and of course, investment opportunities. So, Aidan, over to you, and I think you're going to share some presentation slides, some guidance for about 20 minutes, and then we're going to have a bit of a Q&A.
I do, yeah. Cheers. And yeah, I mean, that is the goal, is to hopefully not bore you all with a really amazing uh, presentation for this, to be honest. It's technically, yeah, it's going over everything. So, like in the title says, it's self-assessment limited companies because they're the bread and butter for everyone. And any clients that are currently on the call will know that I've covered majority of this in the initial calls I have with them. But it's to go over a bit more detail on things that might have changed in there, especially with making tax digital, and avoiding the extra quarterly filings as well. But then also a lot of the main issues is wealth management as well, where once you started earning money, what do you do with it? So that is the main goal for it all, and this is yeah, that's what the presentation's for. So yeah, unless there's anything you want to add, Gordon, I can just start plowing on through the slides and then do the Q&A.
Absolutely.
Brilliant. So yeah, I mean, the first question really is, are you self-employed? And a lot of people do miss out on this, where they think, oh, well, I'm only earning a couple of grand, it's under 12.5K, so therefore I don't need to do any self-assessment. But then the actual limitations are, if you're earning over £1,000 in a year, so April to April, that's when you actually have to declare that you're self-employed, even if got no tax because you got the 12.5K personal allowance. So yeah, you still have to do it. And a lot of people are getting it from brand deals, sponsorships, ad revenue as well via like YouTube, Twitch, TikTok. So it is a growing sector, and there's a lot of different avenues you're earning the money. Even if you're getting gifts as well, that can always be something that triggers it. Although usually it's quite difficult to start earning more than £1,000 in gifts from like sponsored content and things. But even TikTok gifting, where even in the name sounds like it's a gift, it isn't. You're actually providing some level of service, some level of business, and then yeah, as soon as you reach the 1,000, that's actually declarable as well. So yes, the main deadlines, and as much as I can harp on about this all the time with every single call I ever have with someone, it's the same thing where it's 5th of April is the end of the tax year. So I didn't really have a cake this year, but yeah, about two weeks ago the tax year finished. So 2027's is now underway, and that's going to be running until 5th of April 27. And yeah, it just means every single bit of income you have during that 6th of April to the 5th of April time period is going to be taxable, dependent on expenses and then what your ending profit is. But during the year, you've also got a few other main areas you need to be aware of. So 5th of October, although this is something usually an accountant would do for you, they would register for your self-assessment. But if you, let's say, earned money in March 2026, that would mean if you've gone over the £1,000, you're self-employed for that tax year for 2026, and you've got a deadline of the 5th of October 2026 to actually register for self-assessment as well. So you do get that leeway of about 6 months, but it's better obviously to get it done sooner than later when you start actually earning the money. But yeah, an accountant can really help you on that anyway, because they can do it themselves via an agent gateway. And to be honest, it should be one of the value add things they do. The biggest one, which I know a lot of creators hate, is the 31st of January deadline. So this is as normal every single year. This is when you have to file and pay your taxes. Now, it's always better to get it done sooner than later, sending in information to the accountant, getting everything prepared. But one thing as well is you need to be saving money at the same time and setting aside that cash as you're earning it, because otherwise, yes, you got a 9 months deadline after the tax year to file and pay it. You'd still be having to double pay and double save, really, which you want to avoid. You want to be able to at least say you've got the money and it's actually time to make that money do something for you, which I'll explain later. And then the other one is 31st of July. So if you've got over £1,000 in a tax bill, this is when your payments on account really start to trigger. And payment on account really is just paying in advance for next tax year. So at the moment, for 2026 tax year, you're going to be paying in January 2026 because it added on to your last year's tax, and you're also paying in 31st July 2026. So then when it gets to January next year, you've already part paid, or if not fully paid, your tax bill, and you're only having to pay little bits and pieces on towards your next one. And it can be a bit to get your head around, but yeah, it's like you're in advance paying for next year's tax, but then it can also help things as you go down the line where you've got lower tax bills after the first year. Taxes to pay. So this is one of the big ones where, especially when it comes to higher earners, because you're only taxed on your profits, so it's your income minus your expenses, but you've got four different bands you're part of. So if you, like everyone, most people, you've always got your personal allowance, so you get your first 12.5k of earnings tax free, no issues there. Any profit within that you don't have to worry about. Then from 12.5 to 50k, that's when your basic rate kicks in, and it's 20% income tax and then a further 6% national insurance, so 26% overall. Your higher rates, and this is where you really get getting stung by the government. So it's 40% income tax and 2% national insurance for anything between 50 to 125,000. And then at that point, additional rate is 45% income tax and 2% national insurance. And that's on anything above 125k in profit. But there is a little trap that people fall into as well, where anything between 100,000 and 125,000 pounds in profit, you also start losing your personal allowance. So the effective tax rate is around 60% instead, because you lose your tax-free amount as well. And yeah, it's always one of those ones where you really need to start planning around, whether it's via pensions, limited companies, reducing your earnings, anything like that. Because I mean, what's the point of working if you're only taking home 40% of your money at that point? So there are a lot of expenses you can claim. And I mean, like I say to everyone, creators and anyone that's on social media have got huge flexibility for this as well, because what a normal person would be able to claim as, let's say, a plumber, electrician, builder, or an accountant, you just can't claim the same things. And for you guys, it's a hell of a lot of stuff, because you can be very flexible in the type of content you're filming as well. Whether you're a travel blogger, you do UGC, you do live streaming, gaming, even OnlyFans. You've got a lot of different things you can actually say, well, I needed to do that for my business. So as normal equipment and software, I mean, this is part and parcel. You're going to need cameras, you've got your phone, you've got your microphones, and if you're editing, whether it's Adobe Acrobat, even well, any other editing apps, even Facetune, things like that, where you're doing little bits and tweaks to your features, especially if you're doing like modeling, then those are like integral to your business, and then yeah, you get to claim it. You've also got phone and internet, so partly covered just previously the phone. You claim a percentage of what you've actually got. So with your case, you'd be saying, let's say I've got one phone for business, one phone for personal. You're able to claim the full cost of that one phone used for all your business stuff. So you're managing your social medias on there, interacting with fans, posting content, editing content as well. But then you've also got the same thing with laptops and computers, because a load of people do edit on there as well. So you've got a lot of range on what you can claim. Other bits and pieces as well is even props. So if anyone's got filming rooms in their rental or their own house, then anything that's part of that room, because it's 100% for business, desk, chair, sofa, bed, wardrobe, LED lights on the wall, anything that makes the aesthetic for your videos, you can also claim those, because it is only 100% for business use. Travel. So this is actually the best one. And it's always the way I like to phrase it to people is, if you're wanting to go abroad somewhere, make it that it's the majority of the use, if not the whole reason for going, is for business. So if someone's going out, you can collaborate with other creators, you can be going out there for travel vlogs, you can be doing it for normal social media content, and you've got to be making sure you're getting some level of business benefit from this, because otherwise HMRC can just turn around and say it's called dual purpose. And what that is it mix between business and personal benefit. And as soon as there's even maybe 1% personal use from it, they'll be able to say, no, you're not going to have it. And I've had that a lot of times in inquiries, where you need a hell of a lot of proof of what you did, or you need to spend a lot of time out there, at least as a sole trader, doing enough work to benefit the company. Now, this is different for limited companies, but I'll explain how you can get around that in a bit. And then, yeah, the last part on expenses as well, the main ones that a load of people spend on is marketing, freelancers, editors, management, all these different things. You have to have them in order to expand your business or even to save your time. And because it's all very, very specific to you actually running your business and your operations, then yeah, completely claimable. So yeah, all of those. There are little bits and pieces, but all of the separate expenses you might want to question, feel free to add in the Q&A at the end. Managing the tax. So, I mean, this is one of the ones that's always caused people problems over time, and it's about playing catch up with your tax savings. Now, most of the time when you're a sole trader, you'll be having a 26% tax rate. If not, maybe you're unlucky and you're hitting the 42% as well. And you just need to be making sure that you're actually setting aside the money as you're earning it. Because otherwise, let's say you've not saved for 2026s, you're going to now have to be saving for your 2027 tax bill because it's the new tax year and saving for last year to then be able to pay it off when it comes to January. And it's not a good loop to get into because the best way to get out of it is either earn more money or you start spending less money. And neither's like the the easiest way to go about it. So always set aside cash and yeah, keep it in a separate account. Any income you get, have a separate personal business bank account. At least you can then see from there exactly how much is coming in each month, how much you're sending out to yourself, and then you can manage exactly what the business spending is. So then you know if you're actually on track with saving. But this is also the other big one, because you've got 9 months as well before the deadline for paying. Instead of giving it straight to HMRC as soon as you know your tax, actually put it in a savings pot. So savings ISAs, because the 0% tax, got no issue on those. You can constantly earn interest on it. Then before the 31st of January, just pull it out, then pay your tax bill. So if you've got 10 grand, usually the average interest rate is around 3.5%. So with that 3.5% on 10 grand, you've made about 350 quid in a year saving it. And if you're saving from the start of the tax year, so April 2026, you've got 20 months of interest to be able to claim on this, or at least to earn before you end up paying tax for that tax year. So yeah, there's huge amounts of money that people could be missing out on if they're not saving the money. And then the alternative is premium bonds, because the main goal is to not pay any tax on your interest, which if you're a normal taxpayer, it's £1,000 of interest you're allowed. If you're a higher rate taxpayer, it's only 500 quid as well. So premium bonds is also a way around it because it's classed as gambling. So think of the National Lottery. Although you don't lose any money that you put into it, you're just playing for a chance to win interest in that month. So you're not guaranteed it. So the average return is usually like 0.3, 0.4% less than just a normal savings account. But then you also have the opportunity to win up to £1 million. So it's whether you want to have the risk, and the trade-off's usually about 50 or 60 pounds for the average person saving. So it's a day out. So it just depends on your risk tolerance. And if you want to have a bit of fun each month when they do the draw. So something to keep in mind. But yeah, always keep your savings on target every single month, because otherwise, yeah, you'll be playing catch up and it's never a fun game to try and fix. Now that brings on to limited companies, though. So I know quite a few in the call have got limited companies, and some have got ones in Dubai as well. But the main trade-off for a limited company is you've got higher taxes as a when you've got up to £50,000, and the reason for it is you pay yourself in a combination of salary and dividends. Now, salary, you do 12.5K because it's just personal allowance. There's no, it's all tax free, and you get to claim that off your tax bill for your corporation tax. And then dividends is what you pay yourself up to the £50,000. And now, because the government increased it, it's 10.75% on those dividends. But the main thing people do forget is that you've also got corporation tax, and it's all about splitting it. So you've got your corporation tax between 19 and 25%. And then in the best case scenario, you pay yourself up to 50K, and then you're going to be paying 10% roughly tax on that. So overall, you've got a tax rate of, on average, 30%, which is a bit higher than the sole trader. But where the difference comes in is limited companies are used now mainly for tax timings, because as a sole trader, you're going to get taxed no matter what on the money you receive between the 6th of April to the 5th of April. But with a limited company, you can then decide, well, I'm not going to pay myself more than £50,000. So therefore, let's say you make £100,000 in profit. you'll be getting £100,000 at 20% tax, so £20,000 tax. Whereas if you were a sole trader, half of that money, £50,000, would be taxed at 42%. Whereas if you keep it in the limited company but just don't pay yourself, you're saving 22% in tax at that point because, well, you only be paying 20% corporation tax. So although, yes, the money will be locked in the company and you'll have to do things with it, whether it's reinvest in the company, put into stocks and shares, pensions, things like that, it does help avoid the big higher rate tax hit on you. And then also the same thing, if you're earning over £100,000 in profit, you don't have to lose your personal allowance either because you're limiting what you pay yourself to 50,000. So you're going to be nowhere near that limit and that threshold. So it saves you even more. So the more profits you make in your company, the better it is to be on a limited company as long as you're not needing to send yourself majority of that money as a salary and a dividend. But other benefits as well as limited liability. So if anyone's doing reviews of products or even manufacturing, selling of merch, a lot of these things could bite you in the arse if you're a sole trader because it's just under you. It's your personal name. There's no legal separation. But with a limited company, as long as you're not breaking the law, you're not committing fraud, then you've got that extra little gap where they can't come after you. Sure, they could come after your company and you've got insurances set up for that, but they can't actually go after you for your own personal assets where you could lose your house if you've lost a court case against someone, or you have to put up a load of collateral for an insurance claim and it just isn't feasible for financially. So lots of things to protect you as well with that. Tax efficient strategies. So this is also something to add on. So like I mentioned earlier about travel costs, when you're a sole trader, HMRC are a lot more on the ball, a lot more anal about whether you can claim travel because they look at it going, well, have you had personal benefit? Because as a person, you're needing sustenance and shelter. So you'd have incurred costs for your food and for like staying somewhere anyway. Whereas with a limited company, it's like your company is telling you, you need to go to this location. There's enough of a business reason to go to that location. So let's say you're doing 5 hours of networking, collaborations, content shooting, anything like that. But because you're benefiting the company, there's enough reason for it, then you can claim that cost through the company because it doesn't matter if you're getting a personal benefit, it's as long as the company has had that benefit. Now, if you did take the piss a bit and you did maybe 1 or 2 hours worth of work each day and you could have done it at home or there was no real reason to be out there, or you could have done it all in one day rather than spend a week in an all-inclusive, then that's where the benefit in kind taxes and other things where HMRC will just put a stop to it and they'll say, no, you can't claim that. You've got to pay dividends on it instead because it's personally benefiting. But as long as there's enough of that business reason there, then yeah, you've got a lot more flexibility in claiming it. Pension contributions. Now, it's the most unsexy part of any talk about finances, the other problem as well, you can't take it out until you're 55, but you do get tax relief on it. So if you had £10,000 lying around at the end of the tax year, you'd already done other investing or reinvesting in yourself, and you thought, you know what, I don't want to be paying extra tax. If you put that 10 grand into a pension SIP for yourself, directly from the business into your director SIP, then you can actually then get 19 to 25% tax relief on it. So in this case, it'd be 1.9 to 2.5K off your corporation tax bill. And then, yes, the money's going to be locked away, but then you're still going to be earning on that for decades until you do hit that retirement age. And it's always good to have some sort of fallback plan, I guess you could say, because otherwise, yeah, you'll come to the point where maybe everything's gone a bit tits up and you won't be able to say you've had enough savings and you're still having to work at the age of 70. Whereas other people around you might have saved a bit more, had a bit more of a pension retirement pot, and then enjoying life on the beach like this image that I've put on the slide. And yeah, that's the overall limited company improvements is tax savings for your how you pay yourself, dividends and salary. You've got your easier to claim travel costs, and then you've also got your pensions, which get you a better discount. Because if you did it via a sole trader, you don't get it off your tax bill. You instead get it a top up in your pension pot by the government instead. So if you put in £10,000, you'd actually get 2 grand extra into your tax pot, which is great to get extra money, but you may just be wanting to go for it for the tax relief rather than just getting the free money. Yes, so there are some pitfalls though with a limited company, and I've come across this quite a lot, especially when people have come from other accountants who haven't given them the guidance. And directors' loan accounts are the biggest issue for this. So, what a director loan account is whenever you're paying yourself each month from the company, don't think of it. You're thinking it in your head. It's going to be £1,000 salary, £3,000 for a dividend, and you're thinking that's all that needs to be done. What actually happens on the accounting side is you're loaning this money from the company to yourself, and you need to either do three things for it. You either need to repay it, which completely gets rid of the whole point of paying yourself this is a salary and a dividend. You need to pay for business items under your personal bank account, and then it's called personally paid business expenses. And what the accountant like me could do is move it from your personal bank into your limited company. That reduces your director loans. You've got nothing or less outstanding at the end of the year. Or what normally happens is you do a dividend voucher. Now, a dividend voucher actually formalizes the money you've sent yourself. So if you've been good, you've stuck to the plan, you've paid yourself £50,000 in the year, 12.5k would be salary, and then we would do, or any accountant would do, a £37,000 dividend voucher. And then what that does is on your side, the director loan account is nil. It means you owe nothing to the company. Now, what happens is some people either don't set aside tax and they have to pay it from the director loan account, which means a higher loan from the company, which then means you need to put more money against it to pay off this director loan, which either means you get hit with 33% dividend tax, or what it's now 35%, or you have to start repaying it, or you get what is called S455 tax. And if you've not repaid this loan, but within 9 months of the financial year end, then you end up getting taxed at 35.75% on it. It is temporary, but the problem is you need to repay that direct loan in full in order to get the 35% refunded back to you. And it's never a good position to get into. It's always good to make sure you're on top of your spending, so you're not having to send yourself too much each year, or you're not spending too much on personal items as well. Because if you went and started paying for your weekly shops or your personal rent or mortgage through the company, that would be classed as a personal loan from the company to you, and you need to somehow repay that. And it either comes with higher rate dividend tax, or you have to take less money each year, and neither is the best option for that. Benefit in kind tax as well. So I know a lot of you have asked me this question in the past about company cars, and it's actually one of the biggest fake advices that a load of people give around. Is company car, you can buy one under the company, you've got no issues there. But what they fail to mention is if you've got even 1% of that car being used for a personal trip, whether you drove to the nearby shop, every other use of it was either for driving to business meetings, doing modeling and different photo shoots in the car, going to track days, doing social media content around it. HMRC can turn around and just say, well, you've had personal benefit from this car, therefore you're going to have to pay benefit in kind tax on it. What that involves is, let's say you get a car that's worth £50,000. You can get taxed then, depending if it's electric or if it's polluting like petrol, diesel, anything between 2 to 38% of the value of that car is going to be taxable each year. And then depending on which type of tax band you're in, whether it's basic, higher rate or additional, you could be getting taxed at 20, 40 or 45% on that amount. So let's say you got a Porsche, which I've had before in a client's case, that's around a 33, 34% benefit in kind rate. So that 50 grand, it was something around £15,000 became taxable. There were higher rate taxpayers. This was about £6,000 in tax just for the pleasure of driving that car because they owned it via the company. So unless you're going to have a company where it's very, very centered around driving cars and you've got them locked up at different driving garages and things like that, or a racetrack, things like those, you're going to run the risk of getting this benefit in kind tax, and it can really like do some damage at the end of the year when you don't realize it. So it's always good to avoid those because, yeah, otherwise you can get taxed a hell of a lot. And that happens every single year. It's not just a one-off. It's the value of that car every single year is going to tax you. Another one is, yeah, it's like I mentioned a bit about the director loan account. It's about mixed personal and company spending, where only ever spend on the company if you know it's for business. Even if it's a business one in the end, but you're not too sure, spend it on your personal bank card, and then the accountant can move that across into your company. You still get to claim it for your taxes. You've got no issues there. Bit of extra admin work there, but at least it means you're not overspending for the stuff, for the personal stuff, which then means your director loan account won't be at risk either. And record keeping is the other final one as well, because the main issue is when you become VAT registered, you need to be able to show an invoice or receipt with the VAT on it if you want to claim it. And it's one of the big issues people keep forgetting is they go for a meal because they're on a business trip, and that's 30 or 40 pounds with VAT on it. And they would have been originally able to claim it if they actually kept the receipt, but because there's no proof of what they had there, then yeah, they miss out on about £6 or £7 worth of VAT that they could have claimed otherwise. Same with if you were going out and buying clothing, especially for any OnlyFans models, where you're going out for lingerie, you can rack up a hell of a lot of costs for those, like Honey Birdette, Bow Avenue, and it's better to actually keep the receipts, keep the invoices, usually on the email, and at least it'll say what the VAT is in it, and then you get to claim that extra amount on your VAT return. And to finish off as well, wealth building. So this is the part where a lot of people don't really think about until it's too late. The average person in the UK has got less than £5,000 in savings, and the average person doesn't start investing until they're 40. And investing and wealth building always is based on time. It's never about being really good at investing, where you're doing day trading. It's more about, as long as your money's in there for longer periods of time, you've got more chance it's going to grow bigger and bigger and bigger. And that's what pension pots do. You could put in £10,000 in your 20s, but you've got 40 years to actually keep that growing and growing and growing. And then at that point, you've actually got a fully fledged investment and pension pot, which you can retire on. So that's the main thing. So yeah, the first one is always about reinvesting profits into the company. You got to think about ROI, which is return on investment, where if you're going to be spending money on the business, think about how much money you could get in return. So an easy one is thinking, do you get a £500 camera or a £2,000 camera? And sure, the camera quality is going to be better, but are you going to be able to guarantee you get more than £1,500 worth of income or profit from having those better quality videos or pictures? Same with an OnlyFans model, because I know there are a few on the call where lingerie, you can be going to Honey Birdette and spending £100, £200 on a few pieces of lingerie for videos, whereas you go to Victoria's Secret and Summers for something that's a fraction of the cost. But would that extra to £70 to £100 you're spending get you more than £100 to £200 worth of profits just because of how it looks? And these are the things you got to really think about, is whether it's actually worthwhile spending that money if you're not going to be personally benefiting from it. So definitely something to keep an eye on. Cash reserves as well. So it's always good to keep some cash in your business, especially if you end up getting sick out of the blue. You've got no other incomes coming in. You always want to have something there. And this is on top of just your tax savings for your corporation tax or for your personal tax. And it's just always good to have a few, maybe a month or two at least, of any of your expenses. This could be for management costs, this could be for editors, for other items that you'd be buying for props, maybe a redecoration of your studio, things like these. You need to make sure you've got something at least. Now this gets onto the more interesting part, it's the corporate investing. So what you can actually do via limited companies is also invest in stocks and shares. So this is normally via an LBA. It's just a normal license that you can get. It's all about anti-money laundering, making sure your funds for your company are all correct. But what you can then do is sign up with AJ Bell and other investment management platforms, similar to like Trade 212, but for business. And you can then put your money that you've kept. So like when I was saying, you keep your profits over 50k in the company because you don't need to self it, otherwise you get hit with higher rate tax. All this money then goes into stocks and shares. Now you don't have to be a guru knowing exactly what you do. You can get some things called index funds, and what the goal of those are is it just tracks the market. So you've got the FTSE 100, which is the top 100 companies in the UK, got the SP 500, which is the top 500 in America, and so on and so forth. And you just put your money in there, and this is money that you don't need to touch at all for at least 10 years. Because there's always going to be recessions, there's always going to be corrections in the market, and you don't want it to get to the point where you're desperate for some extra cash because you're a bit short for that month, and you realize the market's also crashed during that month by 5%, and you don't want to be selling your stocks when it's 5% down. You want to be holding them and growing them. And the main reason for that is because on average since 1930s, 1940s, the average rate on return for at least the SP 500 has been 10% every single year. So every 10 years, your money has doubled, which is the reason for the 10-year period. And you just keep adding and adding and adding to it. So you can treat your limited company as a retirement pot as well. Because at that point, let's say you've got £500,000 of net worth, you can follow this thing called FIRE. It's financially independent, retire early. Quite a big thing that's followed in America. And if you got 500 grand, they say, well, you can take 4% out over the year because on average, if you're gaining 10% in value, 4% you sell, that's going to be £20,000 minus some tax for corporation tax and dividend tax. That's going to be 20 grand of doing nothing. And that can start funding a semi-retirement lifestyle. And then think about it, the more that grows, you got 1 mil, 2 mil, 4 mil, all these different amounts, you can you can get a lot more money from each year and you can just fully retire at this point. Or like some people have done, they end up going into training, doing some jobs that they really enjoy. Or like one of my clients, they wanted to get a horse sanctuary in the south of France. So they need to have the money there to buy the horse sanctuary, to get the horses, and then also to live off the income because it won't be that profitable either when they're down there. So a big thing to think about. And you can also use private banking as well and investment advisors to manage all of these stocks and shares if you don't want to do it yourself. So it's very risk free as long as you keep the money in there for decades because it's all about retirement. And intercompany loans. So the name itself doesn't really show too much straight off the bat, but what intercompany loans are is you have another limited company and you can loan money between them. Because it's a loan, there's no interest on it because you own both the companies, and there's no tax on it because it's not income. And what that's used for is property investing. So if you're wanting to get into buy to lets, Airbnbs, HMOs, you can actually set up another limited company and use your main limited company for your social media creation income, loan that money across, and then that becomes the deposit for the house. Then you can use your main company as a guarantor for your earnings to then go, well, I can afford the mortgage. So in case of the tenants not actually paying for that month or the Airbnb income not being high enough, the mortgage will be covered by your main company. Or with HMOs, they can even base the mortgage based on if you're buying a HMO with existing tenants in it. So if you've got four tenants at 500 quid a month, they could look at that going, okay, well, you can afford a £2,000 a month mortgage on it. And it makes it even better. And the way people use limited companies for properties, it's all about compounding growth. So if your property over 5 years, you're paying off the mortgage, and then you're receiving an increase in the value of that property, you can then remortgage that, so you'll get another 30 or 40,000 pounds of equity. You then use that alongside other savings to get another property, and then you've still got your original one with a tenant in it. You've now got a second property doing the exact same thing, and then it gets faster and faster and faster as time goes on, where at that point you could be buying one or two properties a year by remortgaging and releasing equity in each of your properties to then keep growing it. And that's how a lot of the big investors do that in the property space. But yeah, the overall really the main thing is have long-term growth as your plan. You've got to really think about it, because social media is going to be around for a long, long time, but it depends on how long you yourself want to be doing it as well. And if you want to be at the age of 30, 35, 40, and you could say to people, I'm pretty much retired, I'm only working because I enjoy working, or you're doing fun little projects yourself, that's a lot better than having a great few years, having some good Instagram pictures of you traveling to Dubai and spending £5,000 or £6,000 on a table and bottles in a nightclub, or going to these fancy 5-star resorts. But then you've got no savings, you've got no house, you've got nothing to show for it other than the experience. And it's always good to have a bit of a balance. You need to at least enjoy it, but you need to also think about what you can do and what this money can make you in the future as well. But yeah, and that's the end of the presentation. Hopefully no one's fallen asleep during all that.
That's great, actually, Aidan. Thank you so much. Really, really in depth. And I mean, we could talk about this in. I'm glad we just covered those sort of four areas because, we could talk for ages about it. I want to just go through some specific questions here. Guys, feel free to just put something in the chat. If you want to come on camera as well, then you can. But let me just run through some of these things. What's the implications of a tax investigation from HMRC for a creator?
Um, Not great news, to be honest. They're actually more on the ball recently because they've started partnering with a lot of social media websites as well. So like TikTok, OnlyFans. Well, TikTok's in the process for matching and showing them all the income records. OnlyFans, as of 2 years ago, has already done this. So people are getting letters in the post saying, "We know you've earned money. You need to
Yeah.
declare it, or you've not declared it properly." Vinted, Airbnb, YouTube is only going to be a matter of time. Same with Instagram, Twitter. So yeah, HMRC, because it's all digital, is going to be more and more on the ball with knowing exactly who's earning what. So tax inquiry, usually what happens is HMRC would send you a letter in the post saying, we want to check a compliance check on your taxes for X year. So let's say 2024 to 2025. They'll ask you for any workings you've done, any of your invoices, receipts, your bank statements, the full whack of what your accountant or yourself would have used to actually calculate your tax. They would do their own independent inquiry and review of the work, and then they'd flag up different items. Usually it's around for creators travel and makeup and beauty and clothing. And if they've been claimed, you've got to really fight back on that by saying, no, no, this was actually for business reasons, or I did this because of this. And it's always good to have a spreadsheet noted down where if you do actually buy these sort of items, especially for travel, you've at least got something note to note going, oh, actually, I remember what that trip was for. It was because I was collaborating with these creators, or my management told me I needed to go there, or I was doing a brand video and they flew me out. So things like that where it does help fight your corner. But yeah, so an inquiry, it does cost a lot if you're needing, because usually you need an accountant to go through all of this with HMRC. Usually once a month they send an email in response to the one that the accountant or yourself would send them with answers to any of these questions that they've got. You got to then fight your corner about why you claimed that expense. They usually try their best to say no, you can't claim it, so you got to keep going back and forth with them. And yeah, it's just a bit of an annoying time really, but it can cost you anything between 500 to a grand for a normal tax inquiry. That's like relatively low interaction, but there is insurance you can take out as well, which covers it. Which
That's what I
for
was
for
going to
my
say.
yeah, for my clients at least, I've got an insurance where I only have to pay a £50 premium in order to actually claim the insurance costs. So at least if anyone, which I do actually have a few inquiries ongoing at the moment, I'm able to then once it's finished claim it from the insurance rather than charge them the invoice.
Yeah, great. What do you think of platforms like Zero or other online platforms? Which ones do you rate the most?
Um, I'd say Zero is the only one I like. The others I believe are all only reason to choose them is because they're cheaper, but the usability is by far nowhere good enough. QuickBooks, especially, it's such a clunky software to use. It's all right if you've got maybe a couple hundred transactions in a year. You only need to do some basic analysis, but if you're doing anything much more serious, like limited companies, or a lot more transactions you're reviewing, Zero is by far the best, although it is double the cost per month. So that's the main trade-off.
Yeah, no, okay. I know an issue which is really big in the creator space is getting paid promptly. I think it's different with OnlyFans because it's effectively it's direct payments. But those that do brand deals, we've had many instances where people are whether it be the agency or the brands taking 120 days to pay. Liddy has put a little comment in my questionnaire. So I usually add a late payment clause, but I find this sometimes affects the rapport and trust between me and the brand. So, what would your advice be to reclaim payment? And because I guess some of these people won't have actually gone through debt collection agencies or any of that sort of area, but they've done the work in good faith and they haven't been either paid at all or they've had to wait a very long time for it.
Yeah, I mean the brands they are known, yeah, like you're saying, to take the piss a bit really with payments. Some of the big ones can be fine because they've got a reputation to uphold, but the smaller ones, they just don't realize they could also have their reputation ruined by the creator if they withhold
Exactly.
payment.
I mean, I always think, don't pay a creator at your peril.
Yeah, exactly, exactly. I mean, there's a lot of recourse actions you can go through. I mean, the main one is actually being on top of your invoices, where you know exactly who's paid and who's not. So you're always chasing them. So, like saying that, platforms like Zero, can raise invoices on there, and it sends out automatic reminders once a
Yeah.
week, however often you want it, and then it gets sent straight to whoever you're dealing with on the debt collection side from the brand.
Mm.
So it does help things rather than you having to manually chase them.
Yeah.
Other than that, though, you can either there is some agencies out there that assist. So a normal agency, they do all the debt collection on your behalf, but that's part of the reason they take their cut. Alternatively, there are some other softwares being developed which help go after debts like that. Or you can also threaten them for even if you've got the clause like Lydia was saying about late payments. You can threaten them saying, "Well, I'm just going to go to social media if you don't pay me within the terms." And although yes, it might break the rapport, but then the whole problem is, would you want to work with them again if they're not paying you in the first place? So
Exactly right.
it's
Exactly
it's
right.
it's a difficulty there. And then also small claims court.
Hmm.
Now, it's usually rare to get to that, but it's actually people don't realize how cheap it is. It can be quite a slow process because you've got to wait in a massive queue of everyone else. But you can claim up to, I think it's £5,000 in debts or £10,000 in debts via small claims. And it can cost anything between about £35 up to about £400, depending on the size of the debt you're claiming. And as long as you've got proof of the invoices, the work done, and there's no other reason to doubt that you don't deserve the money, it's just a matter of filling out a form for 1 or 2 hours, submitting it to the government court. Because if you Google small claims court, it comes up with the whole platform you need to use it on, and it can take a few months, but usually the person won't appear in court because they know they have to pay. And then the court would say, well, you need to pay, otherwise we'll send debt collectors around. So and you don't lose anything on top of that apart from the initial fee. So it's always one of the last resorts to go to, but you still deserve the money, and then you wouldn't work with the brand anyway after that point.
No, and I think it's just cementing the reason to have a proper contract between brand and creator so that everybody's clear about who does what when and the implications on either part of what's going to happen if things aren't delivered. Okay, let's wrap through these. Polly says, with the increase in the dividends, do I need to pay back that for this tax year, or is it only moving forward from the date or change?
It would be for the 2027 tax year where the 10.75% change happened. It all depends on when the dividends get declared. So, I mean, in your case, Polly, it would be split between some of the dividends will be classed as an interim dividend. So anything you've paid yourself from your company from September to March 30th, 31st, we'd be able to declare them as a dividend within the 2026 tax year, and therefore you'd only have the 8.75% dividend tax. It'd be anything declared after April 2026. That's when you'll have the 10.75%. But yeah, same thing there. I'd always suggest set aside a percentage of their dividends anyway that you send yourself.
100%. She's also asked about the best way to keep records of expenses. And I know that there are these little Clio expense cards, aren't there, that actually is quite helpful. And whether or not, when you're out and about, like on a restaurant or something, you take a photo of the receipt actually there and then and remember to do it. But with your own experience and given the audience that we've got, what would be your best way of recording everything?
I mean, there's two. So for anything that's relating to travel and making sure like it's a big purchase and you wanting to note down that it was for business use, Google Sheets or Excel spreadsheets, anything like that, where you just have to, because you only have to update it maybe once every month or two,
Yeah.
because there's not usually much you have to put on there. For any where it's receipts and invoices, we use HubDoc on our side, which ties in with Xero, and you'd get access to it and you can take pictures from your phone app or drag and drop them onto the website, whether it's from emails, things like that, or you can forward the emails into the folder as well. So that's the best way of doing it, because you just got to remember to take the picture at the time, because otherwise the problem is usually you get all the pieces of paper and you start chucking them in the bin or you leave them on the table. So it's better to at least get in that habit of taking the picture at the time before you can just bin it. Who cares? Because it's on the cloud, it's saved somewhere, so you don't need to worry.
Exactly, exactly. A question from me now, and you're probably going to say, well, yes, there are people like us, but if there's a creator out there looking to find a new account or actually is unhappy with somebody, what are the sorts of things that you think they should be looking for in this maze of different accountants that are out there?
I mean, it partly depends on what their earnings are because accountants start becoming a big benefit after around 25,000 pounds in earnings because especially for the creative space, because there's going to be time savings as one, but there's also going to be the knowledge of what you can and can't claim. Otherwise, you could be at risk with HMRC inquiries or just not claiming enough, and then therefore you've got a higher tax bill. So it depends on what your earnings are. And then at that point, it's also dependent on how much you want to understand yourself because you can get some really, really basic. They just get the work over the line, but they don't put much quality onto it. So you might be missing out on expenses, but they're at least doing it for you. And then you can get really, really cheap ones, but then you could be also missing out on a hell of a lot of tax savings. Whereas it depends on if you're earning a lot, then it's all about will they be proactive on giving you enough information on whether you should be a limited company or what you can do with pensions or even what you should do with your savings for taxes. And it's if you want to get the more in-depth and proactive and higher quality ones, there's not really many of them around. Apart from myself, which I can't really toot my own horn,
But
but
but but but it's a really good point because I think, when there's a lot of guys here that are busy creating content, that's what they do. That's their happy place. And there's a lot to be said for just having regular accountant meetings, so that has its own value. Your knowledge even here today has been hugely valuable to a lot of people. And sometimes just giving that advice that's very personal to them is probably worth its weight in gold. Hannah says, "Who do you decide when to move from a sole trader to a limited company?" So, how do you decide? Beg your pardon. How do you decide?
yeah, there's two parts to it. Well, three parts really. So, limited company, the overall start where it becomes really, really tax beneficial is the 50K profit. The more you're earning over 50K in profit, the better a limited company is because you're going to stick yourself at £50,000 of paying yourself. So that means any profit above that stays in the limited company, which only gets taxed at roughly 20% at that point. Whereas if you're a sole trader, anything above that 50K range then starts getting taxed at 42%. So you are saving 22% of every pound above that 50,000. So that's the initial one. Travel costs is another big one because you've got to also think about how much you're traveling for the business, and it's a higher risk, a much higher risk of trying to claim those costs as a sole trader. Whereas if you're spending £5,000, £6,000 a year, if not more, on hotels, flights, meals out, because you're having to go to different locations, then that could potentially be £4,000 or £5,000 of expenses you're risking being disallowed as a sole trader. Whereas within a limited company, that's an extra 1 to 2 grand of tax that you can get to claim without any worries about it.
Mm.
Then also the third one is just what your lifestyle's like. If you've got an expensive, flashy lifestyle, then you're going to have to also pay yourself more than £50,000 a year, which then makes it less efficient than a sole trader. So you'd always have to have more profits left in the company than what you're paying yourself to make sure it's the more beneficial route tax wise.
Mm.
But yeah, so those are the three criteria to sort of think about before you do that move.
Hannah also says, "Who has to do the quarterly tax returns?" Well, depends if you're using an accountant, then that's what you would typically do on behalf of your clients, as long as they've given you all of the required receipts, I guess.
That's correct, but I think what Hannah's also meaning is the MTD. So it's the new HMRC scheme, which I can't imagine most people think is a good idea at all. I think is a waste of time on their behalf. But
Yeah.
MTD is now meaning that if you've had a £50,000 turnover in 2026, you now need to do a return every 3 months and what most accountants will be doing is an estimate of what their earnings and profits and expenses are for those 3 months because it's physically impossible to send in information for hundreds or thousands of clients every single quarter to do it within a 1 month deadline. So yeah, every 3 months, the accountant or yourself would need to have a software that declares what your actual earnings and profits and expenses are. And then you still do the normal end of year tax return filing, and that's the one that actually you pay. These ones mean pretty much nothing. It's just for HMRC to track what's going on. But if you're a limited company, if you're paying yourself dividends and salary, then you also have no need for doing the MTD either. So it does help you on the admin side, because dividends, they get declared when they do at the end of each year, and it's not classed as a normal sole trader activity. So yeah, it does reduce that admin requirement.
One thing I'm going to come to you in a minute, Georgia, but one thing that I wanted to ask you is when you get a tax bill and you haven't really planned for it and set that money aside, and the world and his wife have done this running businesses, trust me, it's even me. um, and HMRC ultimately want you as a business to survive. So if you've had a big tax bill, it's because you've obviously generated a lot. Now you may well have spent some of that tax unwittingly and not put it aside. Um, but HMRC will provide you with a payment plan options because and they're really really good actually. I have to say. I wondered if you wanted to just share some advice around when you're in difficulty in some way.
Yeah, I mean, payment plans, they can be quite flexible with HMRC. The big one that, I mean, the deadline's passed now, but 31st of March, you get a 2 month allowance for after the tax year to then set up one online, because it removes the need for actually calling them. Because when you call them, they quiz you on a lot of things about your expenses and whether all of these things are required, and they start questioning, do you really need to spend that much? But if you do it online, you put in your income, your expenses as an estimate, and then they tell you to pay 50% of whatever is remaining as your profits. So that's it's quite simple to do, and it's only if you've got under £30,000 of debt with them, you can do the online one. If you're doing it over the phone, it can take a while, mainly because of just the call hold times to get in touch with HMRC.
Yeah.
But for that, it's the same sort of thing, but they ask you in a bit more detail about your actual spending habits, whether or not you're actually spending this much on your business or what your personal expenses are, because they take into account mortgage, rent, bills, travel costs, other operational costs you've got. And as long as you're truthful enough about it, and as long as the repayment plan length isn't too far, then they'll usually say yes. But they prefer it if it's under 6 months. They can do it if it's under 12 months. But they have been known to grant 20, 30, or 40-month repayment plans, but you got to be very, very specific on the circumstances to get those approved.
Yeah, the amount of money owed to the HMRC, if you Google it, it's in billions. It's quite huge. Last question then, before we sort of wrap up, from Georgia. She says, what about if you're employed and self-employed in terms of moving from a sole trader to a limited company? So she's already employed in a business, but she's presumably got this side hustle or something on the side as well, which I guess is
Yeah,
quite common in this space.
yeah, I've had a few of these recently. It still revolves around the £50,000 limit. So if you've got a normal job that pays you £50,000 in a year, that's your basic rate done. And assuming you can live off that amount as well, then anything you're earning, as long as it's over 5 or 10 grand, it's more beneficial to put it into a limited company, purely so you don't get 42% tax or even higher. And with a limited company, yeah, you won't be touching it, but you can start investing it. You can keep it saved in there, and it's only 20% tax roughly instead. If you're earning lower than that, yeah, it all depends on what your employment is and your self-employed income. Because if you've got 30 grand of employed income and then £20,000 of self-employed, you're still within the basic rate, and it's more tax efficient just to do it as a sole trader. So yeah, it just depends on how much is overlapping into those higher rate bands and additional rate bands.
Yeah, and they can also they can have a partner as a director in that business, and therefore spread the without them even having to do anything, they could spread their liabilities as well, couldn't they?
Correct. Yeah, yeah. So if you've got a limited company, you can also set up a payroll scheme. So not just for yourself, but yeah, you can bring on a partner, friends, anything like that. As long as they're actually doing some work, you can't just say you're paying them for marketing and they don't do any marketing. As long as there is some sort of substance to their work, even if it's just basic PA admin stuff, then yeah, you can do that, and then you could pay them 12.5k as if they've not got any unemployment anywhere else, or you could pay them as a subcontractor. And then yes, they might have to still do their self-assessment return, but if they're under 50k as well, then it would avoid you having to take the money yourself at higher rate taxes, and then that can just be household income, or they send that money to you and things like that. So it would work that way.
Great. Really enjoyed it today, Aidan. It's clear that you know a lot about this stuff, and I love the fact that you are very tailored in this sector. And I'm sure I know we've got a bunch of people here that have probably found this hugely valuable and may already be working with you as well. We'll share this with a wider community as well, and we'll put together a little report. It's the wonders of AI now. But guys, if you want to share anything on social media about what you've got here, not only does it help me in what we're trying to do in helping creators monetize more about what they're doing, and do follow up with me because we're going to do a series of webinars about how to develop and grow your business online. So, Aidan, thank you so much, my friend, and speak to you soon.
Thanks very much, and thanks for joining, guys.